Project cash flow. We have a general discounted cash flow valuation model for valuing multi-year projects, where the value of the project is the present value of the project's expected cash flows discounted at the opportunity cost of capital. So to value a project, we forecast the cash flows generated by the project over its economic life. Determine the appropriate opportunity cost of capital given the risk of the cash flow stream. Use the cost of capital to discount expected cash flows. And finally, sum the present value of the cash flows to obtain the total present value of the project. This is the project's value. In this lecture, we consider the problem of identifying the relevant cash flows of a project. A project's cash flow can be divided into two classes: cash flows from capital requirements and operating cash flows. Cash flows from capital requirements. These are cash flows associated with the investment in the project's real assets. They include the initial cost of acquiring the project, the net salvage value from selling off the assets at the end of the project, and net working capital, including the initial investment in net working capital and changes in net working capital over the project's life. Operating cash flows are cash flows that arise out of the economic activity associated with the project. These are the project's revenues, operating expenses, and taxes on operating profit. 3 general rules to follow in determining a project's cash flows. Only cash flow is relevant. Always estimate cash flow on an incremental basis. And be consistent in the treatment of inflation. We'll consider each of these rules, starting with only cash flow is relevant. Cash flow is the difference between actual dollars taken in and actual dollars paid out when they occur in time. In calculating the relevant cash flows of a project, the following must be taken into consideration. Recall that accounting net income is not cash flow. Net income includes non-cash items, primarily depreciation. Net income ignores cash expenditures on new capital. Capital expenditures are not expensed when they occur in time. Accountants expense capital expenditures over time as depreciation. And net income ignores investments in net working capital. We exclude cash flows to capital. Project cash flow is the production of cash flow, not the distribution of cash flow. So cash payments to creditors and shareholders are excluded, payment of interest in particular. Project cash flows are after-tax cash flows. Recall the separation principle. We separate the investment and financing decisions. Project cash flows only consider the tax consequences of the investment decision. These include the tax deduction of depreciation, capital gains tax on salvage value, and taxes on operating income. We don't consider the tax consequences of debt financing, in particular the tax deduction of interest. It's a tax consequence of the financing decision. Later in the course, we'll find that the tax consequences of debt financing is reflected in the cost of capital. We take all these considerations into account when calculating operating cash flow. Recall that operating cash flow is equal to earnings before interest and taxes, after taxes, plus depreciation. This is sometimes called the bottom-up approach to calculating operating cash flow, because we start with net income, the accountant's bottom line, and work up, adding back non-cash items, depreciation in particular. But note, operating income's earnings before interest and taxes. We don't include interest because interest is not an operating expense. It's a distribution of cash flow to creditors. And we exclude distribution of cash flow to capital in determining project cash flow. Now let's derive an alternative equation for operating cash flow. We begin with earnings before interest and taxes. Net earnings before interest and taxes is revenue minus operating cost minus depreciation. Let's rearrange the equation. Let's multiply revenue minus cost times 1 minus the tax rate, and multiply negative depreciation times 1 minus the tax rate. Now let's multiply negative depreciation through. So negative depreciation times 1 is negative depreciation. Negative depreciation times negative the tax rate is positive tax rate times depreciation. We add depreciation to both sides, and note we now have operating cash flow. Depreciation cancels out on the right hand side, and we have this equation. Operating cash flow is equal to revenue minus operating costs after taxes, and this is after tax net cash revenue. Note that we have an additional cash flow, tax rate times depreciation. Calculating taxable income, we deduct depreciation as a deductible expense. The tax rate times depreciation can be thought of as a tax refund, resulting from the depreciation deduction, and thus it's an additional cash flow. This is also called the depreciation tax shield. It's the portion of operating income that's shielded from taxes by the depreciation deduction. This is the important point. Depreciation is a non-cash expense, but it's relevant for its tax consequences, the depreciation tax shield. It's one of those tax consequences of the project's capital expenditures. This equation is also called the tax shield approach to calculating operating cash flow. Both equations for operating cash flow are equivalent, and their use depends upon the problem at hand. One or the other may be useful in different circumstances, and the choice of the equation depends on which would be more convenient given the circumstance. General rule number 2. Always estimate cash flow on an incremental basis. Incremental cash flows are the change in the firm's total cash flow that follows from accepting a project. It's the additional cash flow that the project adds to the firm's total cash flow. Suppose without the project the firm has $110 million of total cash flow. The project will bring the firm's total cash flow to $115 million. The project's incremental cash flow is $5 million. It's the cash flow that the project adds on top of the existing $110 million. Consider the logic of estimating project cash flow on an incremental basis. An increase in the value of the firm from a positive net present value project accrues to shareholders as an increase in shareholders' wealth. It follows that to increase shareholders' wealth, a project must add value on top of the existing value of the firm. In other words, it must produce an incremental increase in value over and above existing value. And to increase shareholders' wealth, that incremental increase in firm value must be worth more than it costs. So to assess the incremental value a project brings to the firm, the relevant cash flows of the project are its incremental cash flows. An important consequence of incremental cash flow analysis is the standalone principle. Incremental cash flow analysis allows the project to be separated from the firm, to stand alone, and be evaluated on its own merits apart from the firm. This is an important concept that simplifies the analysis of a project. Identifying the incremental cash flows is the key to determining the relevant cash flows for a project. Some points to watch out for when identifying those incremental cash flows. Forget sunk costs. A sunk cost is a cost that's already occurred. These might include the cost of research and development and feasibility studies, any costs that have been incurred to bring the project to the point today when an accept-reject decision must be made. These are costs that occurred before today's accept-reject decision, and they can't be changed by the decision made today. They're history, and they're irrelevant to the accept-reject decision because they play no part in the return on the investment that will be made if the project is accepted. That return is determined by the project's future cash flows and not by any past cash flows. So forget sunk costs. They're irrelevant to today's decision. Beware of allocated overhead costs. Overhead costs such as rent, air conditioning, heat, light, and top executive salaries may not be related to any project, but they must be paid for. Accountants will assign a portion of these costs to the firm's projects, charging an overhead cost. The idea is that all projects must carry their share of overhead cost. But the principle of incremental cash flow says that only the additional cost that would result from the project should be taken into account when appraising the project. A project may generate an increase in overhead costs, or it may not. If the allocated costs are not produced by the project, and if these costs would still exist without the project, they should not be included in estimates of the project's cash flow. Don't forget working capital requirements. The productive activity associated with the project requires net working capital. Most projects require an increased investment in inventory. Project sales generate more accounts receivables. Financing current assets increases accounts payable. As the level of productive activity changes over the life of the project, the required investment in net working capital will also change. And at the end of the project, we assume that the investment in net working capital is recovered. It's assumed that the inventory will be sold, accounts receivables become cash, and accounts payable are paid off. The recovered investment in net working capital at the end of the project is a positive cash inflow. Include all side effects. A project may have incidental effects on other parts of the firm. A project may create synergies. A new product may be a complement for the firm's existing products and may increase sales of existing products. Cannibalization, also called erosion, occurs when a new product is a close substitute for the firm's existing products, and some customer crossover from existing products to the new product is expected. Let's consider a hypothetical Coca-Cola company. It has two products, Coke and a Diet Cola called Tab. The company has these cash flows on the left. The cash flows of Coke are in green. The cash flows of Tab are in dark blue. The company is considering introducing a new Diet Cola called Diet Coke. The company wants to tap into the increased popularity of diet sodas and wants to lever the Coke trademark. Diet Coke is a close substitute for Tab, and some crossover of customers is expected. If the Diet Coke project is accepted, the firm will have the cash flows on the right, where the cash flows generated by Diet Coke are in light blue. A portion of Diet Coke's cash flow is the erosion of Tab's cash flows. These crossover cash flows don't add to shareholders' wealth. Shareholders already have the value of those cash flows. The cash flows that may add to shareholders' wealth are the incremental cash flows on top of that. So it's important to take into account incidental side effects such as erosions and synergies. Include opportunity costs. There's a cost associated with using an existing asset in the project. It's an opportunity cost. It's the cash inflows from an alternative use that are foregone when the asset is used in the project. The alternative use may include liquidating the asset by selling it. Suppose a firm is planning to build a manufacturing facility on land it already owns. Is the land a free good with respect to the project? Or does the land have a cost, even if no cash changes hands? Let's consider the land's cash flow with and without the project. With the project, the firm owns the land, takes the project, and still owns the land, and the land produces zero cash flow. Without the project, the firm owns the land, rejects the project, and sells the land for $100,000. It forgoes this $100,000 cash flow if it accepts the project. This is the cost of using the land in the project. Sometimes opportunity costs are difficult to estimate, but for an asset that can be bought and sold, its opportunity cost is equal to its market value. General rule number 3, be consistent in the treatment of inflation. Let's begin with nominal and real interest rates. A nominal rate of return is the percentage change in the number of dollars from an investment. We invest and earn a return on investment in order to finance future consumption of goods and services. We invest to increase our future ability to consume. A real return on investment is the increase in our future purchasing power due to the investment. And it's the promise of a real return on investment that motivates investment. Dollars do not necessarily maintain their purchasing power over time. The purchasing power for dollars depends upon prices. If prices change, the amount of goods and services our dollars can buy also changes. The inflation rate is the rate of increase in the general level of prices in the economy. If inflation is 4% per year, the purchasing power of a dollar declines by 4% per year. Consider the impact of inflation on investment. Suppose you require a real return of 3% on your investment. If inflation is expected to be 4%, you'll need a return of 4% just to maintain purchasing power. You'll need a total return of more than 7% to maintain purchasing power and to obtain your 3% real return. Rational investors will incorporate the expected impact of inflation on their investment into the rate of return they require for the investment. So interest rates will reflect an expected inflation premium. The expected inflation premium is the additional return needed to maintain the purchasing power of the dollars invested and dollars earned. The Fisher effect describes a relationship between nominal returns and real returns given an expected inflation rate. This relationship is 1 plus the nominal return is equal to 1 plus the real return times 1 plus the expected inflation rate. We can solve the Fisher effect for the nominal return. We multiply 1 plus r and 1 plus the inflation rate out, and subtract 1 from both sides. So the nominal rate is equal to the real rate plus the expected inflation rate plus a cross product term, the real rate plus the expected inflation rate. The expected inflation rate maintains the purchasing power of the dollars invested. The cross product return maintains the purchasing power of the dollars earned. Together, they comprise the expected inflation premium. Let's look at an example. Investors require a real return of 3%. Inflation is expected to be 5%. What is the nominal interest rate? So from the Fisher effect, the nominal interest rate is equal to the 3% required real return plus a 5% expected inflation rate plus a cross product term, the required real return times the expected inflation rate. And we get a nominal interest rate of 8.15%. We can also solve the Fisher effect for the real return and get an equation that we can use to convert a nominal discount rate into a real discount rate. So from the Fisher effect, the real discount rate is equal to 1 plus the nominal discount rate divided by 1 plus the expected inflation rate, and from that division we subtract 1. For example, let's suppose we have a nominal rate of 10% and want to convert that to a real rate, given an expected inflation rate of 5%. So our real discount rate is 1 plus a 10% nominal rate divided by 1 plus the 5% expected inflation rate. Subtract 1 from the division, and we get a real discount rate of 4.76%. Now let's consider real cash flows consisting of real dollars and nominal cash flows consisting of nominal dollars. A real cash flow is a cash flow of constant purchasing power relative to a base year. A nominal cash flow is a cash flow that reflects the effects of inflation over time. Suppose we have a 3-year investment costing $100. The 3-year cash flow stream is in real dollars of constant purchasing power. The base year is year 0. And we want to convert that real cash flow stream into a nominal cash flow stream given an expected inflation rate of 5%. The dollars in year 1 have been subjected to 1 year of inflation relative to base year 0. So we compound the 35 real dollars in year 1 by 1 year of 5% inflation to get its nominal value in year 1. The dollars in year 2 have been subjected to 2 years of inflation relative to base year 0. So we compound the 50 real dollars in year 2 by 2 years of 5% inflation to get its nominal value in year 2. The dollars in year 3 have been subjected to 3 years of inflation relative to the base year 0. So we compound the 35 real dollars in year 3 by 3 years of 5% inflation to get its nominal value in year 3. Now let's convert a nominal cash flow stream into a real cash flow stream given the expected inflation rate of 5%. We have to adjust the nominal cash flow in year 1 for 1 year of 5% inflation relative to base year 0. So we discount the nominal value by dividing by 1.05. We have to adjust the nominal cash flow in year 2 for 2 years of 5% inflation relative to the base year. So we discount the nominal value by dividing by 1.05 squared. We have to adjust the nominal cash flow in year 3 by 3 years of 5% inflation relative to the base year. So we discount the nominal value by dividing by 1.05 cubed. And that gives us our real cash flow stream. And so our general rule 3, be consistent in how you handle inflation. Use nominal interest rates to discount nominal cash flows. Use real interest rates to discount real cash flows. And you'll get the same results whether you use nominal or real figures. Let's demonstrate that with an example. Given our nominal cash flows, let's find the net present value of that nominal cash flow stream by discounting it by a nominal cost of capital of 10%. The net present value, discounting the nominal cash flows by a nominal cost of capital, is 5.06. Now let's find the net present value of the real cash flows by discounting the real cash flows by a real cost of capital of 4.76%. Discounting the real cash flows by a real cost of capital gives us a net present value of 5.06. So our net present values for our nominal cash flow stream discounted at a nominal rate and our real cash flow stream discounted at a real rate results in the same net present value. A very short note on depreciation before we look at an example problem. Recall depreciation is a non-cash expenditure that's relevant for its tax consequences on project cash flow. The project's after-tax cash flows are increased by the depreciation tax shield. Cash flows for capital projects are influenced by the way depreciation is calculated. Depreciation procedures are specified by tax law, specifically by the Accelerated Cost Recovery System as modified by the Tax Reform Act of 1986. In determining depreciation, the first step is to determine the asset's property class, which establishes its life for tax purposes. I have some examples of a 3-year, 5-year, and 7-year property class. Once the property class of the asset is identified, depreciation is calculated each year in the depreciation schedule by multiplying the relevant year's percentage by the initial cost of the asset. The depreciation schedule also determines the asset's book value for tax purposes. When the asset is sold, taxable capital gains are calculated. Book value is initial cost minus accumulated depreciation.